welcome. I'm Woodall. I'm joined by Mike Rarey from CAP STRAT. Hi, Mike.
Hello.
We're here for the March 2022 market update. It's been quite a month, quite a start to the year. So we're going to recap March, talk about the year, give you some updates on what's going on. Let's first head right to the bongo board and look at the numbers for March.
So we'll take a look at asset class returns, these numbers through the end of March. If we focus on the column furthest to the left, those are the returns just for the month of March. So U.S. equities bouncing off of their lows. S&P 500, Russell 2000 were somewhere near their year-to-date lows in the middle of March. And then after the Fed meeting and the 2 weeks following, bounced off those lows and rallied. Foreign stocks were a bit of a mixed bag. Emerging markets still negative. Fixed income continue to see more negative returns. Interest rates generally rising during the month of March. And then finally, anything inflation sensitive rallying.
So year to date, quarter to date, we're looking at the S&P around right around here. The path was not fun, right?
Yeah.
So we were down, we were level, we were up. What causes all that volatility?
Yeah, we started off the year and basically just started moving down. And a lot of that was the expectations for way more rate hikes from the Fed. And then the market looked like it was finding a near-term bottom somewhere late January. And then obviously the next shoe to drop was Russia invaded Ukraine. And then once again, the market was trying to form a bottoming pattern. A lot of folks at that point were protecting themselves in the options market. And ultimately, we think after the Fed meeting, after options expiration, that's what led to the rally late in March, which led to a negative 3-ish% return for the S&P, but it felt far more volatile than that.
Yeah, it sure didn't feel like a negative 3. Let's get into the wood. So let's start with, you brought up Russia, Ukraine. So here's a great chart of what exactly happened. So take us through this whole process.
Yeah, so Russian stocks go to zero. So if you are a U.S. investor and you own shares of Russian companies, regardless of what exchange you own them in, once you got to late February, early March, you had to assess the value of those stocks at their fair value. And since those stocks were not trading, the Russian stock market was closed and there were sanctions on trading Russian securities. Well, if they can't trade, the fair value is zero. So what you see on March 2nd, that's when BlackRock iShares made the determination that they were going to basically value the iShares MSCI Russia ETF at close to zero. So you can see it was down 79% on March 2nd, and then the data stops. Well, on March 3rd, it was down 100% and has not traded since. And then similarly, the index that ETF tracks, the MSCI Russia index, similarly had a negative 100% return during the quarter. So those stocks marked at a fair value of zero. So these companies, these are large, many of them multinational companies that operate in Russia. They are still a going concern. They're still conducting business activities. The Russian stock market even reopened during March just for local traders. Right. And it was a bit of a propaganda reopening. There was really no opportunity for stocks to go down with how it was set up. But these companies, for foreign investors, for U.S.-based investors alike, you own shares, but they're valued at $0 per share until sanctions are adjusted or lifted.
Right. And what is roughly the value of the Russian stock market and the global stock versus the global stock market?
Yeah. So the MSCI Russia index, for example, it's only 3% of the emerging markets index, which is only 20% of the ex-US index. Which is it gets infinitesimally small. Right. It's very small. So it wasn't a direct markdown broadly for global equity markets. But if you were an emerging market equity manager and you had 8% of your portfolio in Russian stocks, and you've invested in these companies for years and years, and all of a sudden you have to mark them at a fair value of zero, that can really hurt your performance.
Absolutely.
Yeah.
Yeah. I think the bigger impact, obviously, we're going to go to in the next chart, is Russia's impact on oil prices and its impact on inflation, and inflation not coming down as fast as we had anticipated, which has led to the next chart, which is the Fed expectations for rate hikes.
Exactly. Yeah. So what is the market thinking the Fed will raise the federal funds rate to by the end of this calendar year? And this is a chart we've shown throughout the year, and we just have to keep adding more lines at the top. So as we got into Russia-Ukraine invasion, late February, early March, you could see some volatility in the line there. We got somewhere around expecting 5 hikes. And then subsequently, it was clear that central bankers were going to view this crisis for its inflationary second and third order effects, meaning if there's going to be disruption to commodity supplies, supply chains, et cetera, inflation is going to run hotter for longer. And central bankers, not just the Fed in the US, but also in Europe, decided, we are willing to risk a slowdown in economic growth, potentially a weakening in the labor market, in order to make sure we get inflation expectations under control, sort of like willing to lose the battle in order to win the war.
Right.
And all of that talk and that action, the Fed eventually coming in their March meeting, actually raising the federal funds rate by 0.25%. Now the expectation is 9 interest rate hikes this year. Now, those 9 hikes, they assume 0.25% per hike. So there are only 6 meetings left. Okay, so we're not going to do 25 basis points at every meeting. We're going to go even faster than that. And this is very aggressive. This is a very aggressive rate hike cycle that's now being priced in.
And so for the viewers' edification, this actually hasn't happened.
Right.
We've only gone 25 basis points, but the market's really front running this. Comparatively speaking, the 30-year bond is right around where we're supposed to land today. So what happens between first rate hike and eventual where the Fed thinks they're going to take us, or where the market thinks the Fed's going to take us?
Yeah, a lot can happen. So in the last rate hike cycle, for example, you went from point A to point B over the period of about 3 years. And so there was plenty of time for the Fed to see what type of impact these interest rate increases are having on markets, credit markets, economic growth, inflation, et cetera. But here, the pace, if they do follow through on what the market expects and what they've guided to, the pace will be so fast that it's going to be difficult for them to really assess the impact they're having. And so between now and the end of the year, if the Fed gets the federal funds rate up to 2.3%, the first thing you're going to see is the impact on markets. We've already seen it in the bond market, for example. We've already seen it in equity markets, particularly growth areas of the equity market. Then you're going to see it on slowing growth of the money supply. Money supply growth is going to grind to an absolute halt. And that should have a pass-through effect to tighter financial conditions and weaker economic growth. And that is the Fed's tool to bring down inflation. You slow down the economy.
Slow it to almost to a halt.
Yeah.
So May is the next meeting?
Yep.
So we're expecting
43 basis points is the
43
consensus.
basis
So
points.
some folks think 0.25, some think 0.5%.
Okay. Let's move on to the next chart. So we had quite a bounce off the lows. So a lot of talk about bear market bounce. Is this a bear market? Are we in a bear market? Take us through that. Answer that question. Take us through the slide.
Yeah, so this chart, 2 lines on the chart. The blue line is the S&P 500 index. This is since early 2019. And the green line is put option volume. So people buying puts.
Explain that so the viewers understand what a put option is.
Yeah, so a put option would be I want to buy an insurance policy to protect me against losses in a stock or an equity index. And that insurance policy may only be good for a week, a month, 3 months, et cetera. And what are you going to pay for that, right? So when we see a big rise in put option volume, that means a lot of folks are going out and buying insurance policies against the risk of stocks or equity indexes going down. They are protecting themselves.
Right.
Safety. So when we look at the bounce that the U.S. equity market had from its lows in mid-March, right after the Fed meeting, which was in line with expectations, but still very hawkish. I mean, there wasn't a lot of good news that came out of that Fed meeting, right? But the stock market subsequently rallied about 10% from there. And a lot of this is very technical in our view. So if you look at the green line, what you see is a record level of put option volume in January. And a lot of those put options expired around March 18th or March 31st. Those were the big expiries. And what essentially happens here, and this is something we saw in reverse last year in 2020.
Yeah.
But what essentially happens here, if there is a very large increase in demand for put options, and there are not natural sellers, put sellers, the market makers have to step in and they have to make a market. So they have to create new put options. If you are a market maker and you are selling put options, you need to hedge that risk. And in order to hedge that risk, what you do is you short the stock or the index that the put option is written on. And so then what happens? Well, dealers build up this big short position in individual stocks and equity indexes right around the expiration date. Okay, the world didn't end. We're still down where we were. These options expire. They need to close out their hedges. When you close out a short, what do? You buy back the stock. You buy back the equity index. So in a way, a good chunk of this rally that we've seen post the Fed meeting, in our view, is purely technical. It was a short squeeze from options dealers. And as option dealers are scrambling to buy back stock to close out their shorts, the VIX falls. As the VIX falls, other equity investors and hedge funds that use the VIX as a tool, they lever up their exposure.
Yeah.
And now it's almost as if the market thought the Fed meeting was a good thing.
Yeah, they sort of, the other investors get the all clear sign, so they start to go long again.
Right. So we do not put a tremendous amount of weight in this rally we've seen post the Fed meeting. It does not change our outlook probabilities. I mean, we take what the Fed said and the second and third order effects of that.
Yeah. I mean, the volume has been really weak on this rally. So in terms of how we think this plays out next quarter, so we're at the end of a quarter. How does it play out next quarter? Does this reverse? Do we see more put buying?
At this point, the VIX curve is pretty healthy. A lot of puts have expired. There hasn't been a tremendous amount of put option volume. So in our view, a lot of folks that were protected heading into March, now they're naked. They're just running with their long positions or whatever the case may be. And you have this window of vulnerability here where the Fed can't pivot right now, even if they wanted to. I mean, They have to deliver on interest rate hikes. Inflation isn't going to come down. So it's a pretty vulnerable period for equities, probably in Q2 and then moving to Q3.
Great. So let's move on to the next chart. It's that we label the smartest economists in the room. And what are we trying to illustrate here?
Yeah, and this is what we're really focusing on as a result of the Fed meeting and the Fed's guidance and the market expecting 9 rate hikes. I mean, these are the longer term things that matter. So the smartest economist room, that's the U.S. Treasury yield curve. Specifically, when you have a yield curve inversion, that is one of the best long-term leading indicators of recessions. So there are 2 yield curve spreads that we monitor very closely. One is the 10-year yield the 10-year yield minus the 2-year yield. So when that turns negative,
that's the blue line.
That's the dark blue line. When that goes negative, that's called a yield curve inversion. The 2-year is higher than the 10-year. That has generally preceded most economic recessions since World War II with about a 12 to 24-month lead time. And then the actual smartest economist in the room is the 10-year minus the 3-month.
Green line.
So that's the green line. And they're saying conflicting things right now.
Right.
So the blue line is flat as a pancake. It actually did invert late in the month. It went negative. That's the first time it went negative since early 2019. The green line, however, it's actually gone up. So when you get to this point in time, what's happening is the 2-year yield is pricing in this aggressive Fed interest rate hiking cycle over the next 2 years. So it's already inverted. And the 3-month, well, the Fed's only hiked rates once. So it hasn't factored in that hiking cycle yet. And so then we look out into the forwards market, which says, what is the market saying the 3-month is going to be a year from now? Those measures are very inverted, very negative. So the 10-year minus 2-year, 1 year out is negative 47 basis points. That's the most inverted
it's ever been.
In history.
Yeah.
So if that were to happen, that would be the most inverted ever. And then the 10-year minus 3-month is inverted as well at negative 14 basis points. So these are the things that matter.
And so it doesn't guarantee a recession, but it certainly signals that the ingredients are forming for a potential recession. So, what in our recession indicator says, not really a big chance of recession. How does this really play itself out, and how do we move closer to recession, or further away from not having a recession?
Yeah. If you're trying to predict a recession 12 months out, 18 months out, well, the first things markets move in advance of the news, right? So the first thing is you start to see it in the market. So this is a great longer-term leading indicator, but recessions don't happen often. The yield curve has inverted previously, and we haven't gone into recession. So what needs to happen is you need to see the actual economic data start to confirm what the bond market fears. And we have seen no signs of that. Things like heavy truck sales, new housing starts, new orders to inventory ratios, all these more coincident confirming indicators of recession, they're not even flashing yellow at this point. So we worry about this because the market is going to worry about this, even if a recession doesn't happen. Right. And our recession indicator has a lot of other data points in it, and we're certainly happy to share that. As we see when it starts to flash yellow, we'll certainly bring that to the viewers. But in the short term, things look like we're at a point where we could go either way. If the Fed under delivers, we might get this soft landing. So let's transition to the outlook. We had our bear case, which was a 20% probability at the start of the year. Yeah, 20% probability at the start of the year. The essence of the bear case is the Fed has to hike interest rates far more aggressively than they otherwise might have liked because inflation does not come down as quickly as they would have liked. So in our view, in the bear case, we were thinking 4 to 5 Fed rate hikes would be enough for the market to start to price in some bad things. And obviously now, when you think about the pace at which the Fed is going to hike rates, we're going to be at 4 to 5 rate hikes, by Q4, June, Q3. So it seems likely that the Fed is going to get there. And the market reaction to this has been very consistent with what we've seen in the bear case. I mean, we got down to 4,100. Our bear case price target is 4,000 on the S&P 500. So the probability of the bear case has increased. It's probably close to 50% at this point, with that other 50% being all in the base case.
And let's just hit on the base case real quick.
Yeah, the base case at the beginning of the year was 60% chance. Now we would move that down to 50. The essence of the base case is inflation will come down starting in April, May time period, and that will allow the Fed to under-deliver on interest rate hikes. Obviously, we had 2 to 3 rate hikes for our base case. They're going to do more than that. They've put themselves in a position where they basically have to do more than that. But once again, the essence of the base case is they under-deliver on expectations, and the market likes that.
So below 9.
Yeah, anything below 9 would be great, right? So that's why we haven't taken a huge amount out of the base case, just because, we're going to get more than 2 to 3 hikes. But it's very easy to under-deliver now. Very easy.
Yeah, and ex-Russia, we actually are seeing some price momentum slowing in commodities. So the signs of inflation slowing, even with all of this going on, seems to be starting. So, well, that's a good wrap up for this month. Thanks for sharing our thoughts here, and we'll look forward to next month. If you have any questions, certainly give us a call.